You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome to the China Shop. Get on inside. We're opening up special store hours with the amazing team at OrderFlow Labs. I'm Shopkeeper Dan. With me, as always, is Kyle, creator of FinancialIneptitude.com. Kyle, on a scale of 1 to Tom Cruise jumping up on Oprah's table, how excited are you today?
Oh, man, I was trying to think of an answer to this, and it's not quite as excited as jumping up on the table, and that's only because I'm afraid I might have to open up and learn some really... I have to learn more about myself, and sometimes that could be a scary process. So I'm excited, but I'm also a little bit apprehensive, a little bit nervous.
All right, so you're a real Marty McFly of the situation. I'm kind of the bald high school principal, and we're proud to welcome the Doc Brown of the situation, Fleri. How are you doing today, Fleri? Ready to get back to the futures?
I did Back to the Futures. I don't know if I've ever been referred to as the Doc Brown of anything, so I'll take it.
Great Scott, Kyle. That was an awful trade.
Right.
There has not been any DMs like that yet.
As long as I don't have to stand on my toilet and bash my head in order to know what I'm doing.
Right. So we got any big news coming out of OrderFlow Labs you'd like to share today before we jump in and dive on in?
Yeah, so OrderFlow Labs launching officially on the MotiveWave platform here June 1st.
Nice.
So just about a week away from recording this, and probably just a day or so away from the launch here or the release of this podcast. So very shortly. So by the time you're listening to it, either a day away or right there. And some of the members from the team are going to be doing a few other kind of cool promotional things throughout. So definitely look out for that. There'll be some offers, whether you're in MotiveWave, NinjaTrader, or Sierra Charts. That kind of closes the trifecta of the big three there. So pretty excited about that.
Thinkorswim, right?
Yeah, I don't know about the Thinkorswim piece.
Dang it.
They cut the commissions in half for everybody. I know, right? Maybe.
Okay. Well, Kyle.
Yes.
Shall you guide us into this experience? Get this party started?
So the idea for this series is going to be to try to take somebody who, like me, kind of has some idea of what he's doing, but is not necessarily a profitable trader.
Yeah.
And we're going to spend some time with Fleri. He's going to guide us through some of the important things that we need to know in order to actually become a profitable trader. Taking us through this first episode, which is going to be more of like a foundational building blocks. And then hopefully culminating at the conclusion of the series with me and the listeners actually being profitable and trading well.
Wow, that's a lot of pressure.
Yeah, I know. What's the idea?
Especially seeing your trades come through in the last week or two. I'm just kidding. You teed it up too perfect.
I mean, it's understandable. Man. But that's why I think we need to go back to the very, very beginning, back to the futures.
Yep.
Do we just name this segment back? It's official.
I think that's probably what Dan's already worked out.
I love it. Well, I mean, obviously, we've got a short period of time here together each session, and to take anybody from any stage of trading to consistently profitable is quite the journey. But I think we can have some really fun conversations around the things that we've been really successful with, and the things that would maybe be some shortcuts for folks trying to work their way and navigate through all of the educational content that's out there and all the offerings and just all the things that we can drum up as far as like ideas for edge and maybe narrow that process down at the very least to make the process more efficient for folks that are kind of on a similar journey.
I know there's going to be a lot of work with this, and that's something that I'm ready to put in. But one of the things that you spoke to when we first started doing this is about confidence, having the confidence in yourself to be able to click that button. And that's something that I think a lot of news traders, myself especially, really struggle with. So what I'm really looking for and really hoping to gain out of this entire experience is to have confidence in myself and my system and know that when I click the button, I'm making the right decision. It may not always work out, but I want to at least have the confidence to be able to do it.
Yeah, and I think that's something that we all still struggle with, right? Is you put all this time in, and we've had this kind of precursor to this conversation was like we talked about. You put all this time in, you develop a process, and then you show up to the market, and then you still just take trades in the middle of your zones, and all over the place. Right. So. Which is a whole nother, maybe that's episode 7 of this, that mental game. But the key though is that we're constantly working towards filtering and distilling our process down to something that we have that confidence in. So that when we see it, we can hit it. Macro Tactical has really instilled that in me. Great trader, good friend, and that mentality of understanding that you've done all of the work leading up to you clicking that button, and the expected outcome is not a mystery. It's just a matter of, is this one of the times that the probabilities are going to be in your favor or not? And how are you going to act when that plays out, however the market chooses to play it out? Because we have no choice. Like we click the button, like I said, buy the ticket, take the ride.
You can't tell the driver where to go.
not NQ. No, you can't. But yeah, I think that confidence comes from understanding a bunch of things that we'll hear, I think, in this conversation.
All right. Well, where do you want to start?
Why don't we start with like that homework routine? I call it homework, but why don't we start with just like generally, what does a process look like? And then we can sort of jump into, if we have a process and we have some trade theses, what is sort of the anatomy of a trade and how do we build out a trade and understanding some of the math behind that. But, from this homework perspective, I always call it homework. There's probably a better name for it. I always just call it homework because that's what it feels like. And I do my charting usually in the evening time versus in the morning. The morning is usually just a little bit of a refresh. But, one of the things that I had mentioned on Twitter recently was that anybody can draw lines on a chart. And actually, most of us do it pretty well. It doesn't matter what it is. If Kyle, I know you're doing a lot of like volume profiling with ledges and things like that. And the levels look really good, right? And they should, because there's something that we've looked at a lot. But, anyone can draw those lines on the chart. But the key, at least for me, and that what I want to try to potentially instill or encourage people to do is to draw that same line every day. And then you watch how the market auctions around these lines, and then you can start to take some notes. And really what we're saying, and kind of to tie it back to what you mentioned before, was consistency is if I draw the same lines on my chart every single day, and then I watch how the market interacts with those lines, and I'm not putting any of my own subjective nature into it. It's simply just journaling and notes around like, hey, what does it look like when we go through a volume edge? Or a ledge, and what kind of price action can I expect? What kind of order flow can I expect to kind of come into the market? What kind of order flow do I not want? And so I think one of the biggest things that we can do is consistency. And that's kind of where I'll pull this back to is, I look at the same roughly 8 things every single day. I look at sort of some high time frame delta levels. I look at daily RTH delta levels. I look at open drive ranges, and if we're approaching a previous open drive range, I look at market profile TPO charts, which essentially they have volume profiles next to them, so kind of similar to what you're doing, Kyle. And then I also look at some of the momentum or trend following type things, like watching time frame alignment from say 1 hour to 4 hour daily and weekly charts from like a swing high low perspective. And so all of that basically it's just a process. So the market closes, I go and I look to see if any of these things have updated. And in each of those homework things, I've then found a few like A+ versions of something that I want to look for. So, for example, let's say I'm looking at our delta, from like a higher time frame. There's a pattern that we call the Leroy Trade, where from session to session, say RTH to the Asia session to the Euro session, that is progressing higher. Each pivot is put in progressively higher. Well, when I come back down to the desk in the morning and I see that, I know that box from the previous RTH to this now Euro session that's closing, that box is going to be a great trading range for me for breakouts in the direction of that continuation. And so then I just look for confluence to other levels. So again, like to kind of tie this all back, the point is that it's the same lines every day. And then when we do the same thing every day, we can start to build confidence in some of the observations that we're having around the market. Because, and again, this is just a personal thing, but for me, it's all about patterns. And really, it all just kind of drives back to that anyways, whether you're taking breakouts on, a new first 1 minute candle to make a new high or something like that. Or if you're, using OrderFlow Labs tools and you wait for price to come into an area of your interest and one of the execution tools to fire, like the EAD or the Dominator or something like that. It really is just a sequence of patterns around these areas that we're looking at day in and day out. So again, consistency. It doesn't have to be 8 things. As a matter of fact, it should probably only be about like 3 to 5 tops of some version of the way that you're going to generate areas of interest to watch for the market.
That's interesting. Actually, some of the better momentum I think I started to get was actually making part of my routine, doing the zonings in the morning. So at 7 a.m. I get up, I get on the Discord here and our Discord and with one of the other members that jumps in there with me, we plot out like where we think that the interesting levels are going to be. The part that I think I've been missing though is the journaling aspect and paying a lot more attention to what is going on as those levels interact. I try to write down some observations, but definitely doesn't sound like it's in depth to what you are recommending. So what are some of the things that you're looking for when you see those interactions?
Yeah, so we'll use an example of the session delta pivots, which is sort of one of my intraday, automated lines on the chart that come from OrderFlow Labs. But anybody can really kind of look up how to create these levels. There's YouTube videos out there that we've made on it. But as price approaches a reversion to mean version of this trade, so we're outside of say the pivot on one of the extensions. And I'm looking to take this trade from the extension back into the pivot. So I'm looking to revert to mean. When I see that trade, essentially I'm looking to trade from this extension back to the inside. I'm going to then watch, okay, what kind of patterns can I recognize about when we try to break back? And I want to kind of group those into two main categories. What got in my way and pissed me off, right? Like what made the trade not work? And, and just general observations. And that can be something as simple as, VWAP was in between my take profit one and the extension or my entry. Right.
Okay.
And you just note that and you journal it. I do it in an Excel spreadsheet, but it doesn't matter, paper, whatever you do. But it's kind of keywords. And then actually what's cool about Excel is then you can kind of filter that.
Right.
But then, you filter it and you go, okay, let's look at all my losing trades and then let's look at my notes or my observations from those. And all of a sudden you're like, well, wait a minute, half of these losing trades, I've got this note that says VWAP in between entry and take profit one. Well, now I've got a little something to work with here. And then I can go back and kind of do the same thing on the other bucket, like winning trades. Winning trades, what were some of the characteristics of my winning trades? It was the first rebid off of a higher high. We were building volume above the opening range. We're above the opening range. Again, like whatever these general observations are, if you're using OrderFlow Labs tools, maybe one of the execution tools fired and brought you with momentum across the entry or something along those lines. But again, like kind of the point is, it doesn't have to be some, mind-bending Back to the Futures, observation. It can just be something simple, like it wasn't the afternoon, right? Like it was the morning, and it was the first hour, and this trade success rate is much higher in the first hour. The afternoon, you don't see that bigger move that gives you the full reversion to mean. Again, anything that really just sticks out to you, or anything at all, and then you just start to filter that, and you'll start to pick up some patterns on that. Like the VWAP was obviously one that I ran into on a reversion to mean trade. You don't want VWAP in the middle of your reversion to mean. It tends to cause a problem, or at least a slowdown. And you certainly don't want it before your take profit one if your main target is on the other side of it or something like that. So
I think that might have actually happened to me today.
VWAP tends to get in the way sometimes, or at least slow down your plan. But yeah.
Yeah.
Yeah, so the observation piece I think is really big as well, and again, it doesn't have to be anything big. It can just be some of the things that were frustrating, and usually they stick out because you see them over and over again. And I think if you're really being honest with yourself, a lot of times you probably see it coming too. And if you take that note and you're like, there's a 100 lot on the offer, and I just got long, and he's refreshing. We probably knew then this wasn't going to work. And, if you're thinking it, at least, and you sit through the trade and you let your bracket play out or whatever you do, at least take a note of something like that. If there's something they put makes you uneasy, it should probably end up in that journal around like how price is interacting with that level.
That's an excellent point. There's been many a times where I think like, I should probably flatten this. And then by the time I actually go to do it, then it's either too late, you've already been taken out, or you're one or two ticks away from your stop, and you think, well, might as well just let it play out now at this point.
Yeah.
I get in trouble when I'm like, I'll move the stop down a little bit to stay in the trade because I still believe.
The moving the stop and the hopium.
The hopium.
I mean, we're all there. We're all there for sure. The hopium. Like, this will work. If I just give it 5 more points, it'll work. But the thing too to tie back to the consistency is you really want this piece of consistency to be the few things that you can control, right? Like we can control when we click the button. We can control how much size we use when we click the button, and we can decide, what are the parameters of our trade? Where am I going to exit this trade? Whether it's a stop loss or we're scaling out or completely closing the trade in a profitable situation. So, we can control only so many things. And so we might as well keep these things very consistent so that we can at least put them through a good feedback loop, because without consistency, there is no feedback. And I think that's the biggest piece that a lot of folks miss is they're jumping around and they're trying a bunch of different strategies. And although I think that's a great thing to do, because that's certainly how you discover a lot of the things that you probably ultimately will fold into your process, but you need a process for that as well. You can't just let everything come in. You can't throw it all on the wall and see what sticks. You have to be intentional about, leaving some of the noise out, and then, kind of maybe let a few other people decide for you. Like, hey, Dan's doing really well with these reversion to mean trades with the session delta pivot. So then Kyle kind of picks it up and is like, yeah, maybe I'll spend a little bit of my time that I've allocated to chart work to looking at that, some of the patterns. And once you find that, then, potentially you can work it into your process. But without consistency, there is no feedback loop, because we're just constantly changing things. If you're moving your stop, if you're taking profits too early, if on this trade you were in, your 2 lots, in this trade you were in 5, and in this one you were in 10, how are you going to be able to accurately, find some consistency around the emotions that you put in? And so I think especially as new traders, that's super important, because it's one of the few things that you can really control, especially when you're probably not going to be creating and observing the market as sharply as someone who's been doing this for several years or decades and has that comfortability, because they're already comfortable with the market. You're not. And so, again, controlling those few things that we can, the areas where we do business, and that comes from drawing the same dang lines on your chart every single day. How much size that we use, and when we decide to click that button, and the observations around the market when we do that, and then you've got a great feedback loop, and that's a great place to start, because now you can start to use your stats, and you can start to use some of your general notes to improve on what you're doing, and all of that kind of comes together to one thing that I like to call, like, is it paying rent? And so if you find something in your process, like, again, this reversion to mean trade, and, you've maybe taken the time, you've traded it 100 times in sim, whatever, it's a good place to practice. Or you've taken 100 trades on, your most comfortable size of risk, and you have some good notes on it and you have some feedback. Now we can make a decision, and let's say, that trade didn't work out well for us, and we didn't see any patterns that we were really confident in. The few winners that we did have in this trade, the risk to reward ratio maybe didn't quite, satisfy how many times we would have to take this trade, and the potential of the trade is shadowed by sort of the risk of the trade. And we can filter that out. So that trade's not paying rent anymore. And so now we've freed up more time to focus our attention from a homework perspective in other areas that might pay rent, potentially different lines on our chart or different patterns, maybe just around the same lines.
Mm-hmm.
Because maybe those areas are still good, and we just need to find another way to work those areas.
Do you ever revisit a setup that maybe you didn't like in the past, but you learn some more stuff, come back to it like 6 months later, and then test it out again to see if maybe now there's a difference?
Yeah, yes, I do. Usually when I'm struggling, which is funny, if I'm going through a tough sort of week, month, whatever it looks like, and I just feel like I can't click with the markets and it's just not working. I can't click the buttons right. I'll almost always go back to the good old trusties. And some of those I don't even use too much anymore, which is funny. But a lot of simple price action stuff, like pop pullbacks and just trading retracements, and maybe even get the old fib tool out, just something that can just be come on, see, you guys have been there, right?
Yeah.
So something that can just at least I can no brain consistency this thing for a little bit and build a little bit of confidence back, especially with a trade that I have some confidence in, or one that I've fired off 1,000 of these trades and I just kind of know that I can lean on this and
Mm-hmm.
Yeah. So certainly dust off the old ones from time to time.
You mentioned, we talked a little bit about the risk management and position sizing. Do you want to speak a little more towards that?
Yeah, so I think this is the next big piece of the puzzle because, like we just talked about, there's a need for consistency in the areas where we want to do business.
Mm-hmm.
And we're going to filter those areas that we want to do business through just observation and some information about how successful these trades were. So the next piece is designing sort of a trade. And I think what we'll do is, as this conversation continues, we'll dive into more about what is the specific anatomies of some of the trade styles, because there is no right or wrong way.
Mm-hmm.
There's definitely math that we can use to decide whether or not what we're doing will work in the long run, and or how volatile what we're doing will be if we continue to do it that way. And so I think the two things that we can sort of wrap our heads around and potentially would be a good takeaway for those listening to review if you haven't heard of this is understanding how much of our account we're going to use on each trade. And there's a great process for this that kind of designs some of the math. And it was developed by a few folks, but the Kelly criterion, and then it was sort of made popular by Ed Thorpe, who turned that Kelly criterion into a strategy for beating blackjack. So essentially what this is optimal bet sizing. And so they can take how much money we have in an account, in your trading account, in your bankroll for blackjack, whatever it is. And you can decide what is the optimal bet size given how much money I have in my account and the success rate of the probability of me winning and losing.
Mm-hmm.
And so through that formula, you can sort of decide how much that you should be allocating from a risk perspective for each trade. And so that Kelly criterion is usually a bit aggressive, and there's kind of two different schools of thought here of on the full Kelly criterion, you're using a pretty large amount of your capital in order to optimize the times that you're successful. And as long as you can keep up your win rate, in theory, your risk of ruin should be pretty low. What I personally do is about a third of a Kelly, so fractional Kelly is what they call it.
Mm-hmm.
And so it ends up being roughly about 1 to 2% of your entire account for each trade's risk. And what this does is it takes your actual stats into play. So let's say that you have stats across say 3 or 4 setups that you're doing, and you can pull these stats out, and that on average you are going to return say a 2-to-1 win rate. Mm-hmm. Across all of your trades. And that's with you taking profit early sometimes. And that's with you, holding super runners one day and just that whole average. For the most part, you're going to be about a 2-to-1. You can enter that information in and it will tell you sort of what your optimal trade size is based upon all of this information. So I think that's really important for people to know. It doesn't have to be the Kelly criterion, but I think it's a really good place to look around the thought process of what goes into deciding how much risk you should allocate and how important that actually is to your survival. And I think obviously risk, it's the most important thing that we can do here. It's probably one of the things that we all struggle with. I know I have a massive issue with allocating too much risk at times. And, I think especially as new traders, we get it right sometimes and you see that potential, right? Like you get it right. And you go, wow, look at that trade. Did you you hit that first, whatever the big trade is for you in your head, right? Like whether it's $500, $1,000, whatever it was, you hit that first one and you go, wow, I can do this. I can do this every day. If I took 5 trades like this and you're napkin mathing your Ferrari. And Yeah, you got the house on the lake already, and all the things, right?
Yeah.
But I think what's important there is understanding how to kind of build up to that point, because we can get those things, right? Whether it is that what you want or whatever. But if you just go in this thing, and you make one good trade, and there was some mistakes that were baked into that process, like you were oversized or even undersized potentially. Mm-hmm. You're not going to be as efficient as you could. So I think the Kelly criterion is a great place to start to just understanding bankroll management, account size management, and risk management, because again, this is something that we can control. So when we're new, we should focus a ton of our attention on the things that we can control. And, I had this conversation with a good friend of mine, Baba Yaga, on Twitter the other day as we were kind of preparing for this and talking. This is something we talk about a lot, but these controllables, especially as new traders come in, they should take up so much more of your attention than dreaming up the perfect setup and trying to find this magical thing that you can, you're going to trade the opening range perfect every day, whatever that is. There's these few things that you can control, and those should be the things that inside and out. You should understand why you allocate, a third Kelly on every position, and how you decided that you're a 40% win rate or a 60% win rate. How honest are you about those stats? How accurate are those stats? Those things we can dive into and be really, really intimate with what those numbers are. And then what is the importance of those numbers to us, right? So if we can put together a system that, has us driving a Ferrari in 3 months, but it's going to put us in such stress that, we're having a hard time, maybe you have another job, right? Or, your family and all the things that, can kind of bring into a factor. We should really take the time with these few things that we can control to be able to really fully explain them, understand them, know them forwards and backwards, and use that as sort of this foundation of good trading. I know why I draw these levels every day. I know why I risk $160 per trade and I trade, whatever it is, like a 4 micros or something, right? Mm-hmm. I know why I don't take profit before 40 points or whatever it is, and all of these things are super important. And then you can kind of, again, through this consistency with these few things that we can control, kind of get that feedback loop. So that first one, as far as the math of the things that we can control from a risk perspective is bet size, right? So the Kelly criterion and bet size. The next one, and I would call that R, what R or risk are we allocating to a trade? The next one is, given the trade setup that we sort of created, let's say, simple math, we're going to risk 10 points and we're going to take profit at 20 points. We have a 2-to-1 risk to reward ratio. Given our trade idea and the 2-to-1 risk to reward ratio, what is our actual win rate when we execute this strategy? And so, we did with OrderFlow Labs, we did a liquidity zone challenge. We had just kind of created the new liquidity zones, and I did 100 trades, basically never changing my bracket. And in those 100 trades, there was some tough things to sit through. There were some really fun ones that went really far, and there were some that just kind of slammed right in my face. But the point is I didn't change really anything once we kind of had established what that risk ratio was going to be. And it was a simple 2-to-1 with the runner.
Mm-hmm.
And the runner had the opportunity to kind of come back a little bit. But it would always stop at like a 1-to-1 R. And so I had these trades where I could kind of see from a stat perspective how I was performing. And all of this is important because once we have those stats, once we know what our true win rate is, once we know what our expectation is from a risk to reward perspective, we can find out what our equity curve should look like. And if you don't know what an equity curve is, definitely look up like a Monte Carlo analysis or just equity curve. Because what this does is it says, all right, if I take 500 trades, if I take 1,000 trades, and we run this sort of risk analysis, what are the chances that I run really hot and I win a bunch more trades than I should? What are the chances that I run, sort of average or one standard deviation? What are the chances that I run below average or close to, like just like an anomaly loss that really doesn't have anything to do with you? It's just, the sheer law of large numbers and the math. And I think understanding what that equity curve does and looks like when you consistently execute and maintain your stats, because again, these things that we can manage, I can manage if I move my stop or not and how much that stop loss is. I can manage where I take profit and if I do that early or not, and if my trade is good enough to get to this target that I've established. And once I have all those stats, I can throw it right in this thing. I click the enter button, and it's going to spit out what is my expected expectancy if I take 1,000 of these trades.
Mm-hmm.
And I think it's, one, really important for folks to understand what that math looks like, but two, understand what that looks like for you in the long term as far as like how profitable it is. Like, I think a lot of people underestimate how quick you can go from a $50 day and being consistent there to a $100 day to a $200 day to a $500 day to $1,000 days and so on and so forth. And again, that all comes from consistency and, the experience and the nuance and the advanced tools and some of that stuff can certainly, help adjust that equity curve a little bit more up to the right.
Mm-hmm.
But again, like when we're new, let's really understand how important it is to check your stats every day and see if you're maintaining your equity curve. If you're supposed to maintain a 40% win rate and X amount of risk per trade and X amount of profit per trade, and you're falling short of that, you need to kind of evaluate your system. And again, it's a great feedback loop. So to kind of recap that, Kelly criterion, talks about bet sizing, position sizing, and then, sort of that equity curve lets us understand if we execute like this over and over again, how well can we expect to perform over a long period of time? So it sort of shows you what are the law of large numbers so that you don't have to get all caught up in having a Ferrari next month. You can know that you can get the Ferrari, next year if you perform exactly accurate. And I think that's one of the cooler things that I just really love about the math of this is that if you control the controllables, the profits sort of are just a byproduct of a great product.
That's very well said.
Yes.
The equity curves and the Kelly criterion, you sent me some videos on that a couple days ago. I'll make sure that those get put in the episode description so people can learn a little bit more about that.
Awesome. Yeah, that's some great content. I love that stuff. It's always learning, right?
Right. You mentioned the liquidity zones challenge again, and they kind of got my brain juices stirring here now. Tell me if this is a terrible idea or not, but with the levels and stuff that I've been planning out and trying to try to figure out a way to trade these, would there be any value in just trying to see, like maybe for the next week, I'm going to put a limit order in the middle of each zone, and I'm going to put a take profit at the next zone above, and just see how many times that works. Nothing else. Don't try to look at order flow. Don't try to throw in more variables. Just try to distill everything down to the zone itself. Do you think there's any value in trying to do something like that?
So yes, I think the value, so one, I know it's profitable because I took 100 of those trades and I've seen the equity curve on them. Two, I think it gets you really comfortable with understanding that there's certain things where the math can just take over.
Mm-hmm.
And I think that's probably one of those few setups that, trading against sort of the trap traders of the liquidity zones, it's got just a good enough win rate. Whereas if you just buy the ticket, take the ride, you're probably going to end up slightly profitable over the long run, if not, much more so if you run pretty well over, say 100 or something like that. But I think what it teaches you is the discipline of that, right? Like picking the trades. Where I don't love that idea, or where I think maybe we do that and then we revisit this later, with you taking this from the very entry level process of, hey, here's an automated zone on my chart. I understand why it's on my chart. And that's, hugely important. Understanding that there is offsides delta and all the things that go into, creating that liquidity zone.
I'm not talking about the liquidity zones. I'm talking about just my zones that I create in the morning.
Oh, your zones. Yeah. Yes. Same thing. Yeah. Same thing. I think that's fine. But same thing, like understanding, why those are on the chart, right? Mm-hmm. What you do, because you made them, and then just maybe taking some arbitrary trades on them on like a 2-to-1, and then seeing what that expectancy is. Because what you can start to do is this, and this is kind of where I was going with it. Of you can see like, okay, on the ones that I got stopped out, how many points of MFE did I have? Mm-hmm. Assuming probably it's going to be your max stop, right? So on the ones that worked, how much heat did I have? Did it only go 2 points against me? Did it go 3 or whatever? Did it come one tick for my stop loss? And then you can kind of start to build some nice stats around that. And I think that's a great place, or at least that's how I would start to kind of build some of the nuance around your levels and some of the observations. But again, kind of like the thing that I was going to tie back to is then in the future, maybe then we start to make some more advanced observations around those levels versus like just blindly clicking in at the front.
Right.
But I think in looking at those levels you've been sending me every day, you probably should have been blindly clicking in on the front.
I know.
Because they've been good. That's funny.
They've been clutch levels. I've been using them to trade options.
I think just taking the decision making out of it and then being able to just observe, not having to stress about where an entry or a take profit is going to be, actually sounds like it'd be very helpful to try to.
Oh, that's so nice.
I can take those two variables out of it. Then now all of a sudden I can focus on some of the other ones that I can't control.
And you'll get to learn that patience of understanding that when you allocated that risk, that, there might be some things and some observations that later you're like, oh, cut this one. But like, I think that's more advanced. If we're going to be making the decision to jump in and out of trades when we're brand new, and we don't really have that firm understanding of what some of those nuances may or may not actually be, I think to your point, you're probably better off letting it go. Like if we're not smart enough to make those decisions now, what did I say the other day? What was my quote? Smart enough to be dangerous enough to be dumb.
Yeah, that's it.
Let's just let it play out and feel that too, because I said this when I was doing that liquidity zone challenge. Like one of the things that was really funny was like sweating those trades and learning to just like sit on your hands and just watch it. And it's a little bit of this like hopeless feeling to the market, but it's also good because like my part of this was done, at least since, again, you're talking about consistency and keep it simple. So your job here is to identify the level through a consistent process.
Yep.
And then to decide what your risk model is going to be, whether it's a 2-to-1 or 3-to-1, whatever you land on. And then when price shows up, click the button.
Yeah.
That's it. And then your job is done. And then observe and take some notes about, what are the emotions that you were feeling as price, pushed away? Did you feel like you wanted to move your stop loss? If you did move your stop loss, would it have worked? How good would that have made you feel?
Right.
Does it quickly get to your take profit? Was VWAP in the way? Did some of the OrderFlow Labs tools fire? And maybe you can spend some time focusing on the observations piece and worry less about the entry piece. Now, that's not to say that waiting for the right spot to enter is not extremely important, because I do think it is, but I think it does give you that opportunity, at least for a short period of time, to take that burden off of you and just maybe get accustomed to just clicking the button and kind of hopping in there and taking a little bit of that fear of entry away.
That sounds excellent. I think that is what I'm going to do for the rest of this week.
I'll be watching.
So I need to go through the Kelly criterion too, and I need to come up with a good risk to reward strategy there.
The other thing too is, what is comfortable, right? Like it just because a math equation kicks out, 1.2% of your account size doesn't mean that you should trade 1.2% of your account size. If you're only comfortable trading 0.5%, then do that. If you're comfortable trading, 3% and you feel like you've got the skill set to do that, then fine, do that. But, I think you need to also be comfortable with it as well. And I think that that ties back into some of the setups and some of the things that we're going to look at too, of like when we're building this process and we're looking at levels and we're looking at building trade ideas, those should fit into our vision as a trader, our vision as, quality of life, and our reality of what account size do we have? Like if you're looking to take these monster swing trades and you don't have enough margin to carry trades overnight, like why are you allocating time to looking at swing trades that you might have to hold for 3 days and you don't even have enough margin for, whatever. You're on Thinkorswim and they want $15,000 every night per contract, and you got 10 in your account. Like, what are you doing?
Right.
So yeah, I think that's a huge factor of it too, of like make these decisions based upon what fits you as a trader. We talked about this the other day when we were having a conversation. If you work overnight shift and you're trying to make trading work, and you get off of work and you run home and you got to get the kids fed, and then you got to get the kids out to the bus, and then you're running to your desk and the market opens in 5 minutes and your main trade setup is an opening range breakout, you're probably not going to be too successful because you have no idea what's going. You're jumping into the market. You've got 5 minutes. You should design something. In that case, it's maybe you're looking for trades after the IB sets in, right? And there's an hour of trading out of the way, or after the first 30 minutes, or whatever you do, right? But jumping in and trading the first 30 seconds after all of that chaos, that life can just have from being busy doesn't make a ton of sense. And I really encourage folks to try to come up with trades and homework and trade ideas that fits into their personality, that plays against their strengths and weaknesses, and also meets the goals that they have, from a sort of like quality of life perspective, right? And that's just as important as sort of coming up with this whole framework in and of itself. Of like it has to fit you and sort of especially what your strengths and weaknesses are. Like I know, I'll use Leo as an example. He talked about overtrading being, one of his weaknesses. And so he always holds one runner to counteract that. And I think that's genius, right? So, first of all, then you learn, what it feels like to hold these trades, maybe, when you buy that low a day and understand what it's like to hold throughout the whole day. And he hits trend days and all those things that happen that are a byproduct of always having a runner. But, I think the idea, though, is that his weakness is he overtrades. So if he can learn to sit into a trade to its full expectancy and then really analyze, okay, when is this trade thesis truly done? All of that will just sort of filter down into other good decision-making things later. And so then he can learn to maybe hold his core longer, maybe it's 2 runners the next time and all those things. But again, I think it comes down to, consistency, and in that consistency, being honest about who we are, who we want to be as a trader, and what are the things that are going to be sort of roadblocks to this process. We can control a few things. We got the math, we got the position sizing. We know, what kind of risk and reward we want to do, and we can control how much effort we put into finding out the information here. Like a lot of these programs make this stuff super easy to export. I mean, I can go into Sierra right now and I can tell you whether I'm better on the long side or the short side. I can tell you whether I'm over trading or under trading. I can tell you, what is my win rate? What is my R factor and profit factor, across this week, this month, whatever. And it's just a matter of, are you going to actually take the time and allocate some of your process time to taking this information and your efforts to be consistent, to create a process, to be able to get a feedback loop, to actually do something with the feedback. And I think that's just a great place for us to start, is those controllables. And I think, from a mindset perspective, one thing to understand is like starting here and having a conversation like this is going to be so much more beneficial than starting, at the lake house and the Ferraris and other people's successful trading, posts or tweets or setups. Just because I can execute a trade in one way, shape, or form. And we talked about this. Like, I could post a level and say, here's the buy level, here's take profit 1, here's take profit 2. And all you have to do is actually decide how much risk you're going to take and how much size you're going to put on. And you will not take that trade, but I can easily take that trade all the way to the last take profit. Mm-hmm. And the only difference there is, the confidence that I have in that trade and the fact that I've kind of gone through this whole process. But if you just go, oh, look at this trade setup. He made, $10,000 on that trade. I'm going to do that next time. You're missing all of the foundation work. You're missing all of the stuff. And so you're going to go, yeah, I can do that. And you're going to click into that trade right where I told you to, right? And you're going to be max size. And it's going to come against you a little bit, or it's going to shoot up, hit take profit 1 faster than you expected. And are you going to be prepared for all of those things that come up without doing all of this foundational work? And that answer is no. Mm-hmm. And it still is on a regular basis for me on a handful of trades, throughout the week, throughout the month. And that's why, I love this game, and it's just a work in process. But, we can't put the fruit before the roots. Like, we have to build this foundation. And
did you just make that up? I've never heard that term before.
Can't put the fruit before the roots. Credit to Baba Yaga on that one. We have to own that, right? And I think that's what this conversation is about. And I think that's where it'll progress to, spending the time to nurture this process and to be honest with ourselves, so that later on down this thing, we get to have a little bit more fun, right? We get to, once we get that consistency, or at least like rays of hope of consistency, then we can start to kind of like turn the dials of everything that we're doing. But without, building this foundation solidly first, I think just everybody's trying to out there turn the dials up, down, sideways, bring in some new equipment. And we have like the levels you guys are sending out, Kyle. It's like very simple volume profile, some structure-based stuff, right?
Yep.
And they're great. That's a great place to start. You don't need, some advanced strategy that's coming in from somewhere. That stuff we can bring in later. There's some things that you can certainly do to sort of improve that curve, but OrderFlow Labs.
I like what you're saying about just like knowing yourself. Like, for me, like, simplicity is better. Like, I know that about me. Like, if the more complicated a system gets, the less likely I am to follow it, at least the way I'm supposed to. And I understand that about myself. Other people will have success with those like super complicated, like looking at macro data and trying to fold that in with.
Yeah, it's not me. That's not me. I'm too smooth brained for that. That's funny.
But I mean, I think the more that we've learned, like as we've been studying this game, is that you can be successful with any number of strategies. It has nothing to do with the strategy. Where the success comes from is having the discipline to stick with your risk management strategy and to follow your whatever system you decide to learn and go with. Like, you need to learn that system inside and out. Yeah,
and I think that's at the core of what we're saying here, right? We're promoting this consistency in this process in order to be able to get the feedback loop activated, and so that we can kind of be honest with ourselves and the levels that we've created and the decisions that we've made at those levels. And once we can do that and we can be honest about that process and we get good data, we get good feedback, then we can tweak and then we can make adjustments. Is it paying rent? Is it not? But, you mentioned complicated systems. And I think it's interesting because, I think we build complicated systems and then we simplify the data to be able to use in an easy way.
Yeah.
What you guys are doing when you get your levels in, it's simple to you,
right?
But you've built a complex, you've organized complex data in a way that simplifies it so that you can just put some lines in your chart.
That's an excellent point.
And it is complex work. And I think that's like, as we're looking at, and we dive potentially more into like, what are these areas of interest and how can we generate our own trade ideas and areas of interest? A lot of what we do is taking very complex data or very complex ideas or thought processes and try to simplify them so that we can just, create a small zone on our chart or, some just area to watch.
A click or don't click. You're trying to boil everything down to, do I click or do I not?
Do I want to spend money here or not?
Nice.
Do I want to allocate risk here or not? And some places you want to allocate more. Some places you probably want to allocate a little bit less. And, again, that comes back to that feedback loop. But yeah, the complex, simple systems and simplifying them, because nothing that we do, I think, on a regular basis is simple. I think this this whole journey. You got to be a little bit crazy to kind of stick with this and, kind of dive through the emotions of trading and sort of this whole journey of trying to find the educational content, trying to discover yourself and trying to get out of your own way. And then, once you start figuring it out and you make a little bit of money, how to stay in the game. It's all about longevity once you can kind of get to that part, because you're either trading the open tomorrow or you're not. And we have that decision for the most part, unless you're just slowly bleeding away and today's your last trade. But, for the most part, you're either trading the open tomorrow or you're not, and you own that responsibility. And, especially with all the math and the stuff that we talked about, you can go through these drawdowns and survive them, because that this is just a game of large numbers. And so if you just execute consistently and follow your plan, and then be honest with your feedback loop and tweak where needed, your success is just a matter of time, not, a matter of risk that you allocated haphazardly in a trade to sort of save something, or, because you felt like your back was against the wall, or you had to pay rent, or all the things that, we have come up.
So you're saying doubling every time you lose is not a sustainable strategy? Like if I lose one? No,
martingaling into 100 lots on a trend day down. Although I've done it, maybe not 100 lots, I've done it. It's just not, it's not the way to be.
Something about Toad & Co. just makes me feel good. They only use sustainable fabrics. Their service is super friendly. And they're committed to making the outdoors more accessible for everyone. Their clothes are cute, full of fun prints, comfy, and last forever. It's a group of real people doing the right thing, which isn't always easy. Check out their new spring collection at TOADANDCO.com.
When you look into Discover Student Loans, what you see might surprise you. We can help cover your college costs, don't charge you fees, and give you cash rewards for good grades. Ready to apply? Visit discoverstudentloans.com. Limitations apply.
Sustainable. It certainly isn't. Sometimes you do have to provide liquidity, as a good friend calls it, but I think we'll have that conversation maybe down the road, but that's probably not the foundational conversation of sometimes traders do have to trade. And I think once you get to that feel spot of trading, there's a time and a place to allocate extra risk. Mm-hmm. But that's definitely a more advanced thing, and there's a way to do that, correctly at the very least, or at least know about what do we do when we find ourselves in those bad situations, and how can we practice it? Because I don't think we practice it enough too. And I think that would be a great conversation for later as well, of like practicing when things go bad, which is something that, we do because it goes bad, right? But we don't do it. We don't do it before it goes bad. We're sort of in the moment living with it, right?
Well, let me ask you this. How many people who are generally decent journalers decide to skip those days when everything just goes completely off the rails?
Oh, man.
Because those are some of the hardest ones to look at.
I used to do the trade entry journals, and I've shared sort of my journaling style with you guys, mm-hmm. which is more of observations about the auction at my levels versus execution. Mm-hmm. Because I'm pretty much just using stats for execution. But when you do every trade and you have to make a journal entry, that is a great way to eliminate over trading.
Yeah.
Right. It's like, geez, 26 journal entries today. I just got done getting my teeth kicked in, and now I got to sit at my desk for an hour and a half reliving every one of these bad decisions.
How is it statistically possible to lose every single one of those 26 too?
And that's, journaling is another really big piece of this too. Like I had mentioned, my journaling migrated or evolved, I should say, from trade reviews, which I still definitely do, but it's more of like a personal conversation with friends around trading. Mm-hmm. Like, hey, take a look at this sequence. What do you think about this? Versus, kind of that standard, okay, I entered here. What were my notes? What was the success rate? Blah, blah, blah. How many, like all of those things that you can put in. But I think that's a great place to start of like, hey, I took 25 trades today. Now I got to take the time to write down, all of these trades, and 23 of them were just terrible. And 2 of them were good. Tomorrow you're going to be a lot less inclined to take 23 trades, right? Or 25 trades, whatever it is, because you got to write them all down. And I think that's a really powerful tool to kind of work on the overtraining piece. But I do think it's beneficial to track your execution and just some of those stats, whether it's in an Excel spreadsheet or, some of these sites or whatever. But
I had a conversation with one of our listeners about journaling not too long ago. And like, he was complimenting us and like how consistent we were doing with the journaling and how he was having trouble trying to keep that consistency. And one of the things that we recommended to him was to just boil it down to something simple that you can do day in and day out and start there. Because the important thing is just start. Like, as you do it, and you start to see benefit from it, there'll be other stuff that you want to add to it, and you're going to start adding to it. And then before you know it, you're going to have like a real full-flegged journal.
Well, there's that consistency word again, right? Something that we can get good feedback and good quality results out of, because this thing takes time, man. We spend so much time in the beginning, and I still do. I spend a lot of time at my desk, and each day I'm like, that's kind of the new journey. It's like, yeah, you want to make a bunch of money, right? Now, I want to spend less time making that money. Yeah, that's like the new metric, right? I feel like that's the evolution of watching this stuff. But yeah,
do you know what your dollars per hour is? Do you keep track of that?
Yeah, I was a salary chef for many years, traveling the country at a bunch of different locations, and so that was my job before this. And you never do the math. That was like the running joke. Like, if you're a salary chef, you never do the math because it's so bad. This is probably one of those jobs when you get there, the math is probably worth doing. There's definitely some fun days where you do that math.
You need to know it so you know whether it's worth paying the landscapers $160 to come mow your lawn or not.
Oh, yeah.
Do I make more sitting at my desk or should I go do that?
I felt really good stopping after a good trade this morning. It was like 7:30. I'd been trading an hour. I nailed it and hit my profit level. I was like, I could stop. I got the next hour to do whatever the hell I want.
See, there's something to that too. And I think that's like, so that contentment piece, I think, is another big factor of this too. I had this conversation with Baba the other night as well, where you need to be okay with what's possible too. So, like to your point, you said it was 15, 30 minutes in the market, you had already hit your target. Like, you could sit there at your desk for another 6 hours and, look and hunt for trades. And I'm sure many of them would have come up, and who knows what the results would have been. Or you can just say, hey, that was great. Like, I'm going to bank this win and I'm going to walk away from this, from this situation today, because I'm okay with this amount of money today. I'm okay with this amount of points. I'm okay with these stats being added to my larger, sort of feedback loop. And that's a huge piece, because some of my biggest losses and sort of biggest mistakes have come from days that I was massively green.
Oh, really?
Massively. And back in my poker days, we used to call it being upstuck.
Oh, you're trying to get back to the big number because you take one more and then you.
Yeah, you were up 100 points, and now you're only at 80. So now your next trade,
you're trying to get that 20 back.
You got to make 20.
Nice round number.
But then you're just back to the 100. So maybe you try to hold it for 120 points in the same trade. Now it comes against you, and all the things that happen. Man, it's like it's that curse of like just 5 more minutes, right? Or, just one more trade or whatever that we do. So I think being content and knowing what that level is for you, I think is a huge, piece of this as well. And knowing yourself too around some of those areas. Like, if you're not going to be content unless you make $1,000 a day, you better build a strategy that makes it pretty easy to make $1,000 a day. You shouldn't be hitting home runs in order to get to $1,000 a day if that's what it takes for you to be content. And what goes into that contentness? Is it because you have bills to pay? Is it because you have some mental, goal in mind, or some, thing you're saving for, or whatever it is? I think that's a huge piece of that. And it should be a big factor, because if you hit that spot and then you lose the next trade that you take, being able to say, good enough, like the trade should be why you execute, and the setup, not some goal. And goals are great to have, like, $1,000 I made today, or whatever that is. Like, that's a great goal to have, right? But it shouldn't drive whether or not you take another trade if you're at $900.
Right.
Like, I need one more trade to get, make $100 profit so I can have a 4-figure day. That is a terrible reason to take a trade. You know what I mean?
Yeah.
I think like it's funny because we all talk about that, right? I can hear it in your voice. Like we've all done it. Like,
of course we have.
Yeah, guilty as could be. Trying to get to these numbers are just like, it's so silly that you chase these round numbers when you should be chasing probabilities and setups. And so I think that all comes from being content with, hey, I took 4 trades today. These were great. I took 1 trade today and it might not get any better than that. And what a cool opportunity to have a dollar amount in my account that I'm satisfied with and go do something with my day, because I've chosen this occupation where I have the freedom to do that.
Got to take advantage of it when you can, right?
That is a huge thing. I mean, you guys, we were chatting on, what was last Friday, and I think it was, 30 minutes into the day. So, all right, have a good day, guys.
Yep.
That was the trade idea. Did it. So let's go.
Yep.
Go enjoy the weekend. Start the weekend.
Yeah.
And that's a huge benefit. And so, if we're not always going to be crushing it, we're not always going to be making, millions of dollars and Ferraris and lake houses, we might as well enjoy a 3-day weekend that starts at 8:45 sometimes.
Right.
You're right.
Because you nailed the short, right?
Yeah.
And just let it go. So yeah, I think that's a huge piece of it.
Well, what do we got on tap for next month then? And what should we be doing to prepare for that? Those of us following along.
I think one of the things that we will do in this journey here is we're going to start to look at how the market sort of moves around. We're going to take some in-depth looks at some setups and setup ideas. And, I think I've shared this on this show previously, that one of the books that was really important to me and really understanding that foundation was Markets and Profile.
Mm-hmm.
And so I think what I'd encourage folks to do is, as a takeaway, look at this as a good place to build a foundation of understanding how markets move. Because if we're going to create consistent levels and we're going to try to build those levels day in and day out, and some of those levels may already be coming from Market Profile, but it's going to be really important to understand how does the market auction in and around my levels. And I think a great place to do that is from market auction theory or from the book Markets and Profile. And so, take that book, focus on a few things, look at some of the notes about auction theory, about, laggard traders and early adapters, excess in auctions, balance and imbalance, which will be a huge piece, I think, for almost anybody's trading, and understanding that markets are constantly moving from a state of balance to imbalance. What does value mean? And fair value can be found whether you're using volume profiling or TPOing. And just really, again, understanding what kind of market are we in, which is huge. Are we in a trending market right now? Are we in a balancing market? Is this market in a state of distribution or accumulation? Is it a B-shaped profile, P-shaped profile? All of these things that kind of are covered in this book from a general perspective, as well as some specifics, I think are a great place to start to learn some of the very simple, nuanced patterns that we can start to observe around our levels. And again, another great sort of foundation to put into our process that we're going to build as we go through this journey together.
Are there any YouTube videos that you guys have that talks about some of this too that we can link?
Not with market profile specifically, but Job does have a great video on volume profiling. A lot of the same concepts apply as far as like high value areas or high volume areas, low volume areas, nodes, whatever you want to call them. So I would certainly check that one out. And Dalton, who wrote Markets and Profile, has a bunch of great content. And there's a ton of content available on YouTube around market profile. So
all right, and then going forward too, we're also going to be taking listener questions. This is the first episode, so didn't really have anything prepared for that. But going forward, if anybody doesn't have any questions they want to pose to Fleri, please feel free to email us at 2bullsinachinaShop or 2bulls@financialineptitude.com. That's the number 2 bulls. And they can also message us directly through Discord too. I think we'll be creating a channel in our Discord just specifically for this series.
Very cool. Are you guys going to invite me into that Discord ever, or is this just that awkward moment where I'm like, is that the secret Discord?
You always look like it do not disturb. I didn't want to presume. All right, Dan, wrap this up. We're starting to ramble.
Okay, thank you, Fleri. This has been great. I can't wait to get to the next one. But, unfortunately, we do got to close up shop for the moment. But don't worry, we'll be coming back at you soon with more episodes of Two Bulls in the China Shop and more episodes of Back to the Futures. Until next time, happy trades.
Bye.
Take care, guys.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.